Okay, good afternoon. This is Jim Denholm, founder and CEO of Ironbridge Private Wealth. Today's Tuesday, October 29th, 2024. Going to do a video looking at the election. It's 1 week away, thank goodness. We're going to go over a few different topics. Really, the goal is just to give us a general status of the economy and the financial markets as we go into the election so that we can see if there's changes after the election. So we're going to go through the betting markets, kind of look at the likelihood of a Trump or a Harris victory, talk about interest rates. The economy is stable. The stock market is pretty stable. And then we're going to do a webinar next Thursday, the 7th of November, to discuss outcome of the election, see if anything has changed in the financial markets, see if we have an answer, see how much political and social, societal unrest we have. But anyways, we'll do a webinar next week. Look for details in your email a little later this week. So let's dig in. Betting markets. When we look at the polls versus the betting markets, one thing I like about the betting markets is it's less subjective. It is a measurable, binary, yes or no, who's going to win. The polls can be asked in different ways. The sample size can be different. So both, nothing is perfect. But the betting markets, in my personal opinion, I think provide a little bit more accurate view. So what we look at here, Trump in orange, Harris, that's kind of funny. Harris in blue. The big difference was when Harris did a couple of interviews, and really since then, Trump has really taken a commanding lead. It's almost looking too big to rig, but we'll see. Disclosure, I'm neutral. I don't care. Trump, Harris, with regards to financial markets, I don't care. So we're going to deal with it. It's reality one way or another. I'm not going to be able to change the outcome, but we want to be able to deal with it and see if anything is going to change going forward. But I'm neutral when it comes to the financial markets. Betting markets again. So general election, it shows a pretty strong Trump lead. When we start to look down at the swing states and Congress, similar in the swing states, not so much in Congress, but in the swing states on the betting markets, the 6 swing states are pretty much heavily favored for Trump. Most of these in 2020 and 2016 were flipped. Biden had, it was a close, kind of a dead heat in all of these states in 2020 and 2016. Actually, Clinton had a pretty substantial lead in 2016. The fact that Trump has leads right now is saying that the likelihood at this point is Trump. Balance of power, markets like a split government. Markets don't like when one side gets in and does crazy stuff on both sides. So we could end up with a split. But presidency, like I say, 66% Republican. That's just based on the betting markets. Senate looks pretty handily go Republican. House is more of a toss-up. There are polls that put the House way all over the board, leaning Democrat, leaning Republican. Again, the betting markets kind of have it as a toss-up, which is interesting given the sort of lopsided nature of the presidential race, which suggests that in the betting markets, there's people predicting that top of the ticket will go Trump and some of the rest will go Democrat. Don't know if that's going to happen or not, but we'll see. So betting markets are pretty handily saying a Trump victory. This is an interesting one. So we look at the betting likelihood that Trump is going to win and compare that to interest rates. They're mirroring each other. So, correlation is not causation. So there's not necessarily interest rates are not causing Trump to win or to take the lead. Trump might be pushing interest rates higher, but I think it's also a reflection of the underlying data. One thing we're going to talk about this more over the coming years, but the narrative versus data making decisions based on data, not based on narrative, is going to be a big topic over the next few years. Right now, almost all perception in the market is based on narrative, and it just doesn't match the data right now. We've seen that a few times over the last few years, but this is just a really interesting chart that as soon, and if you look, the interest rates here in blue, almost exactly at the low was when the Fed cut interest rates by 50 basis points. And since then, the 10-year yield has gone from 3.6 to 4.3. It just doesn't look, the data does not suggest lower interest rates. The data suggests stable interest rates or higher. We'll talk about that a little bit, but an interesting chart here. One of the reasons interest rates look like they're going to be pushed higher, we'll look fundamental right now and then maybe talk about Trump. But this is a big part of why we think that we could see higher interest rates over the rest of this, over the rest of the decade, kind of up to 2030, 2031. In my opinion, the federal government made a really big mistake when interest rates were so low, and they didn't do long-term bonds. They could have really issued very long-term debt, 50-year, 70-year, 80-year, 100-year debt at the lowest interest rates in recorded human history. Instead, they did 5 to 10-year bonds, and they're all coming mature. So right now, there's about 16 trillion, almost 17 trillion of U.S. government debt that is marketable. It's about 30 trillion in debt total, but there's two kind of chunks that aren't really available for sale, and that's with the Fed. The Fed owns about 6 trillion, and the rest, which is about 8 trillion, is owned by the Social Security Trust Fund, which is basically burnt, a Madoff. There is no money in there. So really the marketable securities out on the Treasury market are about 16, 17 trillion. I think it's 16.8 trillion. Almost 11 trillion is maturing before 2031. And anytime you have increased supply of anything, this is just basic economics, the price goes down. And when bond prices go down, yields go up. So we've got this 11 trillion that's going to have to be absorbed by the fixed income market. In addition to that, there's almost $2 trillion a year of deficit spending. This is probably the biggest potential difference of Harris versus Trump. It did not make any difference the first Trump administration versus the Biden administration. They both just completely blew up the federal deficit. A lot of that was COVID for both of them, but still, we've got, $2 trillion, and if you look over 7 years, that's about 14 trillion. So call it 10 to 15 trillion. In addition to it, almost 11 trillion. So we're talking about 20 to 25 trillion dollars of treasuries that need to be absorbed by the market. I mean, plus new issuance, that's a lot. And it's really hard to see interest rates going down with this much supply hitting the market outside of a major recession, which we're not seeing right now. So this is incremental. This isn't the kind of situation where you have some treasury debt mature and go on the market, and all of a sudden we've got an interest rate crisis. This is the kind of thing that's just incremental upward pressure on rates. Each treasury auction, there's going to be more and more that they're going to have to finance, more and more deficit spending they're going to have to finance. So all of that, every single auction, you're going to continually be tapping the market. And with that much supply, it's really hard to see rates going down. Fed funds rate. So this is a disconnect. The analysts are expecting more cuts. if you remember the first of the year in January of this year, market was expecting 6 rate cuts. We got 1 so far. I'd be pretty shocked if we saw another one before the end of the year, unless there's war, big war. But outside of that, there's just not the data does not suggest that interest rates should go lower or will go lower. They could, but if we look at, so this chart looks at the Fed funds rate, the average forecast is this white line. So we're sitting here right about 450 right now, or we were we're at 450. Projection is down to 320. So we've got another 5 rate cuts that the market is projecting. The low analyst thinks we're going to get down to 2.5. So we have 200 basis points of cuts. The higher one, 380, still almost 100 basis points of cuts. So, the analysts are either looking at a weakening economy, kind of soft landing, but they're definitely projecting inflation to stay low. This is another one where the data and the narrative are really at conflict. So it'll be interesting to see what happens with inflation. We think it's probably headed higher. Looking at the economy as well, this is, the discrepancy between narrative and data. This is data. And this is one thing that we've been looking at. We look at this pretty regularly, but when we saw the bank failures in a couple of years ago, when we were getting very recessionary data, the GDP estimates still stayed pretty positive. They were positive. And that's what we're seeing right now. So the recession risks were really overblown. We could be seeing the same thing, and kind of looks like from this data and all the data, we've got probably at least 6 months, if not a full 12 or 18 months left before we see any kind of real economic weakness. Obviously, a big event like a presidential election or another assassination attempt or success or societal unrest, all those different things are more culturally significant. When we look at Harris versus Trump, again, we're not going to get into an argument over which one is better, but as it relates to the economy and as it relates to markets, it just doesn't look like it's going to be that different, at least over the near term. So GDP is positive. Things are looking pretty solid. Another thing that we like to look at, credit spreads. Again, we're sitting here very low credit spreads. That signals calmness. If we look at how low this was the previous times, when a couple of things we'll point out. One, previous times we're at this level. We first got to this level about 2005. So we had a couple years of a really good market before, kind of all hell broke loose in 2008. But still, these type of levels on the credit spreads, mid to late 90s, not a bad time to be invested. Late 80s, kind of post-crash, post-87 crash, not the worst time in the world to be invested. Down here in the early 80s, that's when we saw, breaking the back of inflation in the early 80s. So this is calm. This is not saying that the market is concerned about defaults or really just concerned about corporations in general, especially the bigger ones. So this is a good sign. This kind of summarizes what elections do. And if we look from a statistical standpoint, again, narrative versus data, if you look from a historical standpoint, typically what happens is that during the election year, you have a trend. The trend is kind of interrupted briefly for a few weeks to a few months, and then the trend reasserts itself. We're seeing this exact same thing. If we go all the way back to 88, we had a couple down years. This is 2008 in orange. Had a little bit of a pause here leading up to the election, and then it continued. That was Obama. If it was Bush again, actually Bush was over. But if it was McCain, it probably would have been the same thing. I don't think it would have mattered. Again, blue is 2000, saw the same thing, a little pause leading up to the election, trend reasserted itself. The rest of them were positive. And you can kind of see, upward trend. And then right in here, you see it kind of flatten out, and then the trend reasserts itself. You might get a little bit of volatility. Couple scenarios had some volatility and downturns. That was 2004 looks like. So we're kind of coming out of the Iraq war and whatever, but, trend higher, pause, trend higher, trend lower, pause, trend lower, and the trend is up. So, I would assume that trend continues after the election. So keep an eye out, for next week for the webinar. We'll send some information, but it'll be Thursday afternoon, the 7th. Get out there and vote. Let me know if you have any questions. We'll post this on ironbridge360.com. If you have any questions, please feel free to reach out directly to me, jim.denholm@ironbridge360.com. And then we do tend to post a little bit more at Twitter. Things have been pretty calm. Haven't posted all that much, the last few months, but at Denholm_Jim is Twitter. Appreciate everybody listening. We'll send this out via email tomorrow, post it on the website, and then look for some more communication next week. God bless America. Go vote and invest wisely.